Everybody says you need to invest your money to retire rich, but nobody tells you what you should do, or more importantly, what you shouldn't do. But I'm going to change that in this video. This is probably the one place that I'm okay saying that I'm an expert in, because I have made so many mistakes, more mistakes than I can count, and it has cost me a lot of money, but it has taught me a lot. So what I want to do in this video is go over 7 investment mistakes that I don't want to see you make. That way you can keep this money in your pocket and make your mistakes somewhere else. Number 1 is trusting a random person with their investment decisions. The worst real estate investment deal that I've ever done, and it's still the only deal that I've ever lost money on, was a property that I purchased because my ex-contractor told me that it was a great deal, and I purchased it based off of his words, not my own research. I did this deal about a decade ago. It was my 3rd real estate investment deal, and my contractor told me that this property in Detroit was going to be a great deal, that we could renovate this property for about $5,000 to $5,500, and then I could either flip it for a big profit or rent it out and make a lot of money every single month. Now, I'm not a flipper, so I don't really care about the resale price, but I figured, okay, that doesn't sound like a bad deal. Doesn't sound like a lot of renovations. He's a contractor. He knows what he's talking about with renovations. He had already walked through the property. So what could go wrong? Well, turns out everything could go wrong. Because after I purchased the property, I realized that the only reason my contractor wanted me to do this deal was because he needed money. So I wrote him a check to do the work. He took that money and did some other things with it. He didn't do the work in my property. I had to find a new contractor to start doing the work. I had to pay the new contractor again to do the work. The second new contractor screwed up all the work, and we realized that this property had a lot of issues. The plumbing in the property didn't work because I guess somebody, maybe a tenant living in this property before, was not happy with the landlord, and they poured cement down the drain. So we had to completely bust out the plumbing down to the main city line and rebuild it. We had to raise the elevation of the house because the city said that they didn't like the way that the house was sitting. I didn't know at the time that you could raise the elevation of homes, and apparently you can, and it's not cheap. We needed to redo the entire HVAC of the property, new mechanical, new electrical, new ACs, and then we found out that all the stuff got stolen while we were doing the renovations on the property. We had so many issues with this property that I decided to sell this property at a loss because I didn't want to have to deal with it anymore. But I learned that if I'm investing my own money into a deal, it is my decision, not anybody else's. This is one of the reasons why I say never blindly trust a random guy on YouTube, because what might be right for me will not be right for you. So do your own research, and if it's your investment decisions, you got to be the one in charge, and you got to always do your own research, because nobody's going to care about your money the way that you do. And if you want to watch the full video of me explaining what happened in this nightmare deal, I will link that for you down in the description as well. I want you guys to learn from my mistakes so you don't make the same mistakes as I did, because it was very expensive. Number 2, don't put all of your eggs in timing the market. Bank of America did a study on this. They looked at the stock market between 1930 to 2020, and what they found is that if you were able to time the market perfectly and you invested your money for all of these 9 decades, but you did not have your money invested in the 10 worst days of every year of these 90 years, well then over these 90 years, you would have seen your money grow by around 3.7 million%, because you were able to perfectly time the market and not have your money in the market on the 10 worst days of every year. But then they said, if you're not able to time the market goodly, and you invested your money in the markets for these 90 years, but now you did timing the wrong way, meaning you missed the 10 best days of every year of each of these decades. Well, now if you missed the best days, your return over these 90 years would have only been 28%. Not 3.7 million, but now 28%, just because you missed the 10 best days. But if now you didn't try to time the market and you just had your money in the markets for these 90 years, well then your money would have grown by 17,700% if you weren't trying to time the market. What that means is if you can time the market perfectly, you will make a lot of money. But the problem is you're probably not going to be able to time the market perfectly. In fact, you're more likely to be hit by lightning and then on the way home from the hospital to go to the gas station and pick up a lottery ticket and win the jackpot than you are to hit the markets perfectly every single year. This is why for most people, having your money in the market for a longer period of time is the best way to go, because if you do it wrong, well, you don't get to make the big returns. If you do it right, you'll make a lot of money, but this really is not very practical, but you can just keep your money in the markets and see the big returns. However, one thing I do want to add to this is you can also take advantage of downturns, because while nobody can perfectly time the market, you can see when things are going wrong. When the 2008 crash happened, you could see the real estate prices were getting hit very hard. And when the investors were going out and buying real estate after that crash, you could see real estate is very cheap. Just like that, when the 2020 crash happened, you could see that stocks were selling for very cheap, and you could come in and buy even more. So you can use downturns as an opportunity to come in and buy more aggressively. That way you can get even bigger returns, but you cannot perfectly time the market. What that means from a practical perspective is if you're investing your money in the markets, just create a system where you're investing every week, every 2 weeks, every month, and create a set it and forget it system. That way now, no matter what's happening in the markets, whether the markets are up or down, you just keep investing your money. That way you don't have to wait to find the perfect investment opportunity, because the people that are waiting for the perfect time to sell when markets are high will often miss that opportunity, and the people that are waiting for the perfect time to buy when the markets are at bottom will also generally miss that opportunity. So instead of trying to do all that, just set it and forget it system. And then when you see the markets go down, use it as an opportunity to buy even more aggressively, which brings us to number 3. The way that I grew up, it was almost like encouraged to be cheap. And this ended up costing me a whole lot of money, because what I learned is that being cheap is one of the most expensive things that you can do. And I've learned this in so many instances now, with hiring a bad or cheap accountant, hiring a bad or cheap property manager, hiring bad or cheap workers or employees. When you have a cheap property manager, they charge you a lower percentage or a lower monthly fee, which might seem like, okay, if I make $1,000 a month in rent and one property manager is going to cost me less money every single month, that means I get to keep more of my money, because instead of paying $100 a month, I only pay $50 a month. The problem is your services can also suffer. And if your services also suffer, you might not also see the upside, because, well, they are cheap. One of the earlier property managers that I was dealing with their own internal issues, and they were managing a handful of my properties. Well, one of my properties went vacant, and it was wintertime in Michigan, which meant it was cold outside, it's snowing. And one of the things that you have to do when you live in a colder state is you have to winterize the property, meaning you turn off the water in the property. Because if you have the water on and it's running and it's cold inside the property, well, then the pipes can freeze and it can flood the house. Well, they didn't winterize the property. The property is vacant, and somehow the property manager forgot to transfer over the utilities over to their own name. So there was a tenant in there, they had the heat on while they were living there, then they moved out, and then the property manager forgot to get the heat back on and transfer it to their name. So now the heat is off and the water is still on. You can start to see where this is going to go. So now this property is sitting vacant, it's cold outside, and then the pipes burst. And nobody even knows about it. So now this property is getting flooded, nobody knows that it's getting flooded, and some real estate agent decides to go show this property to their potential renter, their potential tenant. They walk into the property and they see a completely destroyed and flooded property. And then they call up my property manager and they say, hey, your property is completely destroyed and flooded. You might want to do something about it. And that's when I got a call. And they say, hey, you have a problem at one of your properties. Oh, really now? What is this problem? Turns out that your property is destroyed and flooded. What can we do? So I proceeded then to have to file an insurance claim, and then I had to go out and fire this management company because I realized that they were doing a lot of things negligently. So when you have a bad property manager, when you had these types of negligent, not very good employees or team members, they can be very cheap, but it can end up costing you a whole lot more money in the long term, especially if these are people that are working to make you money. Because if it's a good property manager, what I've learned now that I've hired good property managers is that number one, they take care of the property. They also take care of the tenants, because you want to make sure that your tenants are being taken care of, that repair requests are being done, the properties are being updated and managed and taken care of properly, but then also that you're maximizing your income potential. Because if market rents are $1,500 a month, but you're charging $1,000 a month, you're still losing $500 a month because you're not charging what you could be charging, so you're losing money out on rents. You want to make sure you have somebody that's looking out for your best interests and is making sure that your deals and your properties and your investments are maximizing your revenue instead of just something that they're doing on the back burner. The fourth thing that you want to understand is diversification, but understanding diversification the right way. So when Warren Buffett talks about diversification, what he says is that diversification is for people that don't know what they're doing. Then other times you hear people say diversify, diversify, diversify because you don't want all of your eggs in one basket. And this is where you got to understand you, your goals, and your perspective on what this means. Because if you don't trust yourself as an investor, then you want to diversify. Because then if you do something wrong, you have a backup plan. But if you trust yourself and you want to see the big potential returns and you want to go all in, then you don't diversify, but you got to understand you're taking all the risk. And what you're doing is going to depend on you. Elon Musk doesn't really diversify. I mean, I know he has a portfolio of companies now, but he goes all in on his companies. When Sam Walton was building Walmart, he talks about in his book, great book, by the way, Made in America, that he hated this idea of diversification. He put all of his investments back into Walmart. He wasn't going out and diversifying his investments into other places. He diversified his money in his own company only. Versus you have other people that will diversify their money into many different types of ETFs and other different things as well. So the first thing I want you to understand is, when should you diversify? You diversify if you want to diversify against your own risks. I diversify my money because I understand that I can make mistakes, and so I want to diversify away from me. When I started off, I invested all of my money into real estate. And then I realized that's not where I wanted to keep all of my money because, well, what if I do something wrong? So then I started diversifying my money by investing my money also into stocks. I diversified my money by also investing into some physical gold. I diversified my money by also investing into startups. I diversified my money by also investing in some cryptocurrencies. Then I realized that I needed to have a different type of investment portfolio that fit for me. And you got to understand now, if you are going to diversify, you got to understand, number one, what does diversification actually mean? Because most people are doing it wrong. And number two, how do you actually go about doing it? So when it comes to diversification, now, if you do decide that diversification is right for you, now the question is, what does diversification actually mean? Because when most people think about diversifying, they think it means I'm diversifying by investing my money into blue chip stocks, emerging market stocks, and real estate stocks. But you're still only investing in one asset class. You're only investing in the stock market, which is a paper asset, which means if the markets go down, you lose because now all investments go down. Real diversification means investing your money in different asset classes. And this is where you got to decide now, if you're going to be investing in different asset classes, what does diversification mean for you? So for me, and I don't recommend what I do to anybody else because I'm just a random guy on YouTube, I invest my money in 5 places. Number 1 is my own company, business, Briefs Media. Number 2 is investment money into physical real estate. Number 3 is investment money into stocks. Number 4 is investment money into speculative investments. These are things like startups and cryptocurrency. And number 5 is I own some physical gold. This is a super rough sketch of what it looks like, but when it comes to my business, you might have heard me talk about Market Briefs. Market Briefs is a free financial newsletter that we publish in Briefs Media. It breaks down what's happening in things like the economy, the housing market, stocks, crypto, and the global economy into a fun, witty, and easy to read newsletter. If you have not read Market Briefs yet, I got the link to how you can join down in the description below. But when I invest my money into things outside of my business, my largest investment is real estate. I like real estate because I own a hard asset and it provides cash flow. Number 2 is stocks. Now, when I invest in stocks, it's a little bit different because I have 2 strategies when it comes to investing in stocks. I have a passive strategy and an active strategy. My passive strategy is a set it and forget it strategy where every Wednesday money is pulled out of my checking account and it's automatically invested into my portfolio of funds. These are funds that give me exposure to dividends, some for value, some for innovation, some for emerging markets. So every Wednesday money is pulled out of my checking account and it's automatically invested no matter what's happening, whether the markets are up or down, if it's raining or if it's snowing. This happens no matter what. Then I have an active strategy where I'm also looking to invest in individual companies. And this is where I'm looking for a good opportunity. If the markets crash and I see a great opportunity, I will come in and buy. If I see a company getting slammed or I believe it's really undervalued, that I think is a good company, it's worth a lot more, then I will come in and buy. But I'm only buying when I see a good opportunity. So those are the 2 strategies that I have when it comes to investing in stocks. When it comes to investing in my speculative investments, this is about 18% of my portfolio. And this is where I'm investing in things like startups and cryptocurrencies. These are what I consider more speculative, where I know that these investments can go right down to zero. But I also believe that they have a lot of upside, which is why I'm investing in them. And so for me, my bulk of my investments are here, but I also understand that, this is kind of like the fun side of things, that if it goes up, great. If it goes down to zero, I'm still okay. And the 2% of my portfolio here is physical gold. I don't consider it a real investment per se. I consider it like owning hard money. It's an alternative to holding cash because my theory is if I bury $10,000 worth of physical gold in my backyard today, and I also bury $10,000 worth of cash My thinking is that in 10 years, the physical gold will have more buying power than the cash because of things like inflation. So 2% is gold for that as a diversification, as a hedge, and just as a type of insurance. So if you're going to be diversifying your money, number one, understand, do you want to diversify? If yes, what does real diversification look like for you? Number 5, do not trade the news. The stock market is very emotional, and especially for somebody who's getting off investing their money themselves in the stock market, it's very easy to get caught up on what's happening in the day-to-day because the stock market can go up and down in the blink of an eye because there are millions of transactions happening every single second. And so now when you have all these transactions happening in the stock market, well, you want to make sure that you're not the person that's just making everybody else rich. And what that means is you don't get caught up in the emotions because a lot of things can move the stock market in the short term. For example, you can see tweets by celebrities that then cause stocks to fall or rise based off of what they say in a tweet. But you don't want to be the person now that's just chasing and going behind these emotions, because over the long term, the stock market follows fundamentals and financials. Over the short term, it follows emotions. And as an investor, you want to be investing your money for the long term. You're not a trader who's trading their money for the short term. Traders can make a lot of money in the short term, but in the long term, traders end up losing to the long-term fundamental investors. So if you want to make real wealth, the way that you do that is by investing your money, not trading your money. And that means you got to get away from the emotion, understand the news, but really pay attention to the financial trends rather than just the emotions, because those trends are going to show you where money is moving through the economy, what industries are benefiting. And this is one of the things that we try to do in Briefs Media, because we have a newsletter called Market Briefs Pro where we help cover the financial trends. Number 6 is you ignore your costs. There are 2 types of costs that will absolutely destroy how much wealth that you will build. Number 1 are fees. Number 2 are taxes. Let me start by talking about fees, because if you invest your money into the stock market through funds, there are some funds that are going to charge you higher fees than others. So I want to analyze 2 different types of fees. One is 0.07% fee, and one is a 0.85% fee, which might not look like big fees or even that much of a difference, but it can make a big difference in how much wealth you're going to build. So if you're investing your money into things like index funds or mutual funds or ETFs, if you have a 401k, if you have an IRA, I want you to take a look at this fee. It's called an expense ratio in all of these funds, and it's something that I want you to consider. So let's take a look at these examples. Investing $1,000 a month for the next 40 years, where you're going to get a 10% return on your money. If you have to pay a 0.07% expense ratio, that means after paying your fees, you're going to be left with around $5.2 million in your investment account. But if now instead of paying 0.07%, you're paying 0.85%, with everything else staying the same, well, now you're not going to pay $10,000 in fees, or $100,000 in fees, or $500,000 in fees, or $750,000 in fees. You're going to be paying about $1 million in additional fees, because now you're going to be left with $4.2 million, because that $1 million difference went into your money manager's pocket. So what you want to be thinking about now is, if you're paying higher fees, is it worth it? Are you getting higher potential returns to justify paying the higher fees? Because these higher fees can end up costing you a lot of money in the long term, and it doesn't take you that much work to switch it if you feel like you're going to keep more money in your pocket, and it can result in tens of thousands to millions of dollars in differences of how much wealth you're going to have. It's the same thing when it comes to taxes, because as an attorney who's not your attorney, what I can tell you is that our tax code has a lot of interesting loopholes, especially for investors. Now, if you're investing your money into the stock market, there are more limited things that you can do. But if you're investing your money into things like real estate, now the options really start to open up, because with real estate, you can buy a property for, say, $500,000. You sell it for $1 million. You think you have $500,000 of taxable income, which it would be that case if it was anything except real estate. But in real estate, you can do what's called a 1031 exchange, which says you take all $1 million. And now if you take the $1 million to go out and buy a bigger property that might be paying you more money every single year, well, now you don't have to pay a penny in taxes today. You can keep deferring this tax bill until you die. And if you do that, you never have to pay the taxes. So understand that taxes are a huge cost, but as an investor, you have the ability to potentially pay less money in taxes, because that's what the tax code says. So get a good tax advisor on your side, because even if you're not investing your money in real estate, if you're investing your money in stocks, you might not qualify for the same types of tax breaks. You still qualify for lower tax rates. And mistake number 7 might be the most expensive for people that make a lot of money. This is you live off of your equity instead of your income. I'm gonna make this a little extreme for the purposes of this example. Let's assume that you invest your money into this thing, and when you do, it's worth $100,000. This could be stocks, it could be a business, it could be real estate, I don't care what it is. You invest your money into this thing, it's worth $100,000, but then the economy starts to boom. You end up finding out that this industry that you're investing in really takes off, and then a few years later, it's now worth $10 million. Now you're rich, at least on paper. Your net worth goes from $100,000 to $10 million because your investment is now worth so much more money. Now what you can do is pull some cash out through a refinance, because every bank is going to say, hey, you have $10 million worth of equity here. You're driving around in a Toyota Corolla. How about you upgrade your lifestyle? How about we give you a 65% loan to value debt? So now you go out and pull out $6.5 million from the bank in the form of debt, because you still got some equity on the table. I mean, you didn't pull out all $10 million. You only pulled out $6.5 million. So you still have a lot of skin in the game, still got a lot of equity. And now you start to live a bigger lifestyle. You go out and start spending this money. You start driving around in better cars. You live in a better home. You go on fancier vacations. You spend this money, but then something bad happens in the economy. Something bad happens to this industry. Something bad happens. And so now this value drops back down to, say, $500,000, which is still 5 times more than what you bought it for, but your income also is not covering all of this. You were living off of this debt game because that's what the banks were allowing for. Now you have many multiples more debt than what the property or this investment is worth. This is what has destroyed so many investors, even the ones that have become multimillionaires. This is the reason why so many investors will then end up bankrupt. It's because you stop living off of the income and you start living on the equity. When you start living off of the equity, this is what makes people go bust. And you don't have to be a sophisticated investor to start doing this. You see the same thing happen when people see their homes go up in value. You bought your home for $300,000, now it's worth $1 million, and you pull out all this cash and you buy a fancy car, you buy a boat, you buy some vacations. Now you have a whole bunch of payments and nothing to show for it. And if the home goes down in value and you can't make the payments, now you get screwed. So if you really want to be a sophisticated and smart and protected investor, not have to run into all those issues, live off of the income, not the equity.
I read a lot of books that say, every real estate investor has one really bad deal. This is mine. So I want you guys to learn from my mistakes. This is not something to teach you in business books or even something to talk about in real estate books. So I want you guys to learn from my mistakes so you don't make the same mistakes as I did, because it was very expensive. Let's take a look inside.